Hi, Dominique, and welcome to another edition of The Week Ahead. This time we're taping on Thursday, UK time, after there was a deluge of some older data. So let's kind of dive right in, as we always like to do, and get your thoughts. Um, Obviously, this is not your average week, but what were your big takeaways, surprises,
My big
things didn't
my,
make sense, things that didn't make sense, etc.
Nvidia's results, just joking, but they certainly made the Fed less important for the market. In terms of the data, so we got a big surprise in NFP, but a positive surprise, which, by the way, Sam's model had predicted. Terrific model, great track record.
Yeah,
Um,
which was amazing because usually it doesn't necessarily predict larger outsize um, results, where in this case it did predict a large upside surprise, and I think the surprise was even larger than ended up being predicted. So, yeah, that's amazing.
100%. But it wasn't that great in terms of economic picture because you had an increase in unemployment and um, slowdown in wage growth. So I think what's going on here is that there is a lot of volatility in labor supply because the immigration policy. People are afraid to leave their homes because they fear that they will get deported. So in the real world, we probably have a lot of uh, uh, unusual volatility in whether people show up to work or not. And then in terms of the survey, the response rate was high, obviously, since the survey was delayed by 2 months. But I think migrant workers were obviously underrepresented in the survey and are likely to be even more now with the government actively looking for them to expel them. So, and I would also add that the data was stale since it's a September NFP. To me, the more interesting and significant data was a jobless claim, which was completely updated. And the end result is that the uptrend in jobless claim has started again. And the latest data we got shows the highest since Q4 2021. So that is really important
You
because
mean continuing claims?
continuing
Fine,
claims.
fine, fine. Yep.
And it's super important because one very reliable indicator of recession is when the rate of increase of unemployment goes up. Typically, when you have a recession, um, first, the unemployment rate goes up, but very slowly, and suddenly the increase picks up. I often think of it as a sailboat that capsizes. If you've ever been in that situation, it doesn't look like it's going to
Thankfully not.
capsize. And then, boom, you get a big whiff of wind and you capsize. And the reason, I mean, it's very intuitive. The reason is that once the economy slows down, you start getting negative feedback loop between employment and consumption. And so those feedback loop means that weakening of the economy picks up pace. And that's why you have this very clear acceleration in the increase in unemployment. And so whenever you see unemployment or insured unemployment, in fact, what's nice about the insured unemployment rate is that it's published weekly, by contrast with the unemployment rate published by the BLS, which we get only monthly, and we're still a month behind, and we won't get October until mid-December, so after the FOMC. So the insured unemployment rate is much more timely. And so when it goes up, I think the Fed gets a little nervous. They have developed an indicator of recession, which is very similar to Sam's rule, but it's
Yep.
based on insured unemployment. And so we haven't hit the recession trigger with this indicator, but we're steadily going up. So to me, that was a more important data point today.
I mean, I see the fixed income mostly rallied across the curve, but it's still around 40% for a cut for December, right? That didn't move much. Yeah.
So I'm still somewhat in favor of a cut, but very marginally so. Really, it's a coin toss, largely because the FOMC has turned more hawkish over the past few weeks, even though the data has moved in the other direction. So I have fairly strong conviction in my view that the US economy is weakening and that in the short term, AI is going to add to economic weaknesses. But given this hawkish bias of the FOMC, we need quite a bit of data to make them cut next month. So
Right.
today's continuing claim is one such data. We need more. So on balance, because of my strong conviction on the economic picture, I still think they are more likely to cut than not, but it's a low conviction call.
And most of their view is still predicated upon inflation is sticky or may even rise more because of tariffs. But has the administration, they have cut back on some tariffs, right? I mean, obviously it's not the huge thing about with the Supreme Court, but they have taken off some goods from exposure to tariffs, or is that wrong?
100% they have.
Yeah.
And on top of that, if you look at the actual tariff rate, so not the tariff that's computed based on what the administration has announced and based on a detailed breakdown of import, not that announced tariff, but you look at the actual tariff, meaning the ratio of the tariff collection to imports, and it's about 10%. As opposed to 18% for the announced tariff. The difference, in my view, reflects largely that big importers have managed to cut deals with the White House and
Fine.
get exemptions. But the thing about the 10% in the spring, just after Liberation Day, you had FOMC members like Governor Waller saying that a 10% tariff was actually his low tariff scenario, that it was manageable for the US. So I would say, one, the tariffs are actually reasonably low. Two, in terms of inflation, you need to think forward, not backward. The argument made by the hawk is that inflation has been above target for 5 years. But the thing is, you need the job of the Fed is not to make up for past inflation performance. I mean, before that, inflation was below target for 10 years. It needs to be forward looking, and for tariff inflation to spread to the whole of the price index, you would need a much stronger economy, a much stronger labor
Right.
market than we have now. And if you look at the market for inflation swap, they are pricing that the worst of inflation is behind us. So for some reason, the hawks on the FOMC have climbed on their high horse and are now demanding that, inflation goes back to target before the Fed starts thinking about supporting the economy. And the risk of doing that, of course, is that inflation could undershoot and the economy could hit a recession. And in fact, before Williams turned hawkish a few weeks ago, he mentioned the fact that R star was still probably quite low. And so, if with a low R star, you have a risk of hitting the zero bound constraint on the policy rate. So an additional reason to be very supportive of the economy.
Okay. I just had a question. Is there a point in like April or May next year? Will there be like a base effect? Like, was there a point that prices did jump initially? I guess it took a while. And like the base effect will actually result in inflation coming in below 2%.
Very possible, but you would hope that the Fed focuses on the trend rather than
Fine.
a base effect. So again,
Yeah.
be forward-looking and is looking at month-on-month print or short-term
Fine. Yeah.
dynamics, and also is really looking at the breakdown between the components of the index. The thing about goods prices, they had started increasing well before the imposition of tariff. The tariff made it a little worse, but basically post-pandemic, we had a change in the structure of inflation. Before the pandemic, we had goods price deflation offsetting above target services inflation. And now we have the opposite. We have services disinflation offsetting a pickup in goods prices, which, by the way, has been goods price inflation has been slowing. Basically, people can't pay, especially low-income Americans. I explained that in detail in my weekly. People just can't afford, low-income Americans can't afford to pay higher prices, and that's limiting the ability of businesses to pass on the tariff. And is probably a reason why employment has been so soft, that businesses can't pass on the higher costs, and so they are not hiring or perhaps even firing.
Right. You're saying like specifically in the service sector.
These are the reason the reason businesses have listed for not hiring more people is higher cost, and also the funding of this very substantial AI investment they have to make.
Right. Okay. Are you surprised by market reactions at all this week? I mean, obviously, well, I'm not sure what I was just out at this lunch, but equities have sold off here quite a bit. But in general, fixed income equities, have you been surprised by the moves this week or no?
So on equities, I've given up predicting. It's all about AI enthusiasm. I mean, my view is that this is truly a transformative economy. I mean, as you know, we at McCoy are developing AI for all kinds of processes, not just market monitoring, but for our own
Right.
internal processes. And I am in awe at what can be done. And I mean, if you have a first-hand experience of AI, you cannot not realize that this is going to lead to job losses. So that the job losses have nothing to do with the equity market, which is really driven by AI enthusiasm. So I'm completely agnostic on how high can it go. I know that it's going to be deeply transformational from an economic perspective. In terms of fixed income, I think this will prove very disinflationary. My view is that we are going back to the low inflation regime we had before the pandemic, and that transition is going to be speeded up by AI. So I would expect bond yields to fall.
Okay. Cool. And then okay, let's turn our focus till next week. Yeah, what do you see? Obviously, next week's Thanksgiving, so it's going to be maybe there's a lot of old releases, but it should be more quiet. But yeah, Fed speakers, economic data. What's your big take, and what should our clients be looking out for?
So far, we have no Fed speakers listed next week, just a beige book, possibly because it's Thanksgiving, you know, everybody is busy cooking or eating. I guess that applies to the FOMC members as well. Beige book is a joke that it's always very beige and it's only half a joke. We're not going to get FOMC moving news there. In terms of economic news, we have the retail sales, the September retail sales, so it's stale.
September. Okay, fine. So yeah.
But
Okay.
here is what is interesting. The Chicago Fed publishes a sort of leading indicator for sales. It's called the cards, and they are going to release it next week. And it's actually a really good proxy for consumption. So we're going to get that, I believe, on Monday. But
Okay.
that's one thing to look for.
Yeah, I'm just looking at it. Okay.
And the other
Yes, Monday.
okay, so that's important. The other important data is going to be the claims, which I believe will probably be on Friday, since Thursday, because Thursday is Thanksgiving.
Correct. Yeah.
So the claims, it's not stale, and as we just discussed, it's a really important indicator. So that's about it for the week. Fairly light. I think the most important news was really the NVIDIA results. It's behind us. I think we
Yeah.
can all relax and enjoy our Thanksgiving dinner.
Just last thing on the political stuff. Do you see the administration doing anything like around student loans? Do you see that? I mean, I was hearing this. They want to institute like swappable mortgages, something like, like, so if you, the reason people aren't moving is because if you're locked in at a 2% mortgage and you sell your house and get a new mortgage, your new mortgage is going to be like 6.3% or whatever. But I guess that anything like that is going to take time, even if it's possible.
That's so I think the news here. So that swappable story.
Yeah.
It's very interesting, but as you said, it will take time. What is more interesting, the discussion, more immediate perhaps, the discussion around the tariff rebate, you know,
Right.
$2,000 per American. I think this week and last week, we saw a really important political shift in that the White House control over Congress has weakened. So we saw the Epstein file vote, which was against the White House initial wishes. Also, during the shutdown, the White House put pressure on Senate Republicans to end the filibuster, which they declined to do. And I think what happened with the Epstein saga is that Congress has become more aware that President Trump won't be on the ballot again, and that the unpopularity of the administration policies, you know, the administration gets really poor rating on inflation, on tariff, even on immigration. Those,
That's yeah.
those won't get rescued through President Trump active participation in the next electoral cycle. And so that is probably what's driving the new independence of Congress relative to the White House, which means that if President Trump wants to go ahead with his tariff rebate, it may not be able to get it through Congress. In fact, this week, congressional Republicans, you know, expressed some doubts on the rebates, assuming that there are any tariff revenues to be rebated to people. That's not what they actually want to do. They want to decrease the debt. So
Right. That was the preface of it. Yep.
definitely. So I think we saw a political shift this week that certainly narrowed President Trump room for maneuver on fiscal policy, and that's really important.
Yeah. Do you think that that fear could be driving Feds, like some Fed policy to not cut if they think that the administration is going to push for that $2,000 tariff rebate? Because
Well,
that would give a bit of a juice to the economy and potentially inflation.
definitely, we saw what happened
We've
with
seen
the
what it's
Biden
happened in the past.
administration.
Yeah,
Yeah. Um, I, there is too much uncertainty. They can't.
fine. You don't think
Yeah,
that's
yeah.
fact? That won't scare people off from voting for a cut potentially. There's other things, but that in itself.
And if anything, the reaction of Republicans in Congress and the loss of control of the White House over Congress actually reduces the risk of more expansionary fiscal policy. So, it's always been a challenge for the Fed to figure out what the next move of the administration are going to be. So they are more likely to react to actual decisions rather than
Fine,
plans.
not floated ideas. Okay,
Yeah.
awesome. Okay, well, I wish everyone in this case, let's just wish you guys a happy rest of Thursday. Um, you know, enjoyable Friday. Good luck in the markets. Then a lovely weekend. And for obviously for all our American friends and some people in London that follow it, very happy Thanksgiving. Um, I can't really talk about it because we did chat and ask rules, but I was telling these guys I just went to a lunch this morning, today with Nigel Farage,
Ooh.
which was interesting. In person he was probably more impressive than whatever. Maybe I didn't have a strong view, um, but a lot going on in the UK these days, and the mood is
Well,
is is fairly dour at times. But it's interesting stuff.
well, we Americans have shown the way in populist politics. So all I can say is fasten your seat belts.
Yes, it should be good for which I know a lot of people in the markets love. Should be good for volatility. So
100%.
um, okay, cool. Well, wish everyone luck, and also as we've talked about in the past recently, we have this new construct um, with now that we've been acquired by BGC. The businesses where we're also now getting a lot more involved in actual kind of global markets. So please, if anyone has any questions around what we're doing or wants to understand more, please feel free to reach out to me. And wishing everyone good luck. Dominique, all the best.
All the best, Andrew. Happy Thanksgiving.
Happy Thanksgiving. Thanks. Bye.